Stocks that offer artificial intelligence have been the hot ticket in the stock market, seeing their prices surge, many to astronomical heights. But let's take a look at some options in AI technology and information technology that might not be so expensive today. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, a.k.a. Mr. Valuation. Artificial intelligence is really the hot ticket in information technology today, and you've seen some stocks like NVIDIA and Broadcom and others that have just surged just to almost ridiculous heights in their valuations, but have powerful short-term returns. But there are a lot of companies that offer artificial intelligence technology and will participate and benefit from it that haven't really got crazy valued. So I'm going to look at, primarily I'm going to focus today on Dell Computer, one of the more innovative PC manufacturers in the world and one of the ones with their third in total market share worldwide. So let's take a look at them, but also let's take a look at Dell's major competitors, some of them international stocks, and kind of take a quick gander at what might be available still in artificial technology where you can participate at reasonable prices today. So let's go ahead and go into FastGraphs and take a look. What I've done here is I've created a portfolio primarily based around Dell Computer or Dell Technologies and its major competitors. And the major competitors in the PC, there are actually 5 of them that we'll be covering here. But what I wanted to talk about here and what I wanted to show you was Dell, because there's some interesting things here from a valuation perspective. Now, number one, Dell just went public again in 2018. The company was founded in 1984 by Michael Dell, and then they grew into one of the global leaders in the information technology sector. But Michael Dell, originally known as PCs Limited, with a mere $1,000 created this company that grew to be such a powerful, innovative computer company, and he did it by designing, manufacturing, and selling computers directly to consumers and eliminating the need for the middleman. Okay, so the company, however, ran into some trouble, and as a result of that, the company went private. Okay, and they went private for a while, and then recently, obviously, they've decided to go public again. All right, and Michael Dell brought the company and returned them to the public markets actually in 2018, as I pointed out. And he bought back tracking shares because the company was finally, after getting through some of their problems that they had, which caused them to go private, restart. So here's what Dell looks like since it went public. Now, the first year, they had a tremendous growth in profits. And then they still had a great year, 24% in 2020, and their fiscal year is January, I might point out. COVID came along, of course, and that didn't affect them very much. They still had good growth for fiscal 2021 of 9%, but then they had a down year in fiscal 2022, followed by an up year, and then they started paying a dividend, as you can see on the fast graph here, in January of 2023. They start out with $1.32. They raised it to $1.48, and it's estimated to continue to grow along with earnings growth. Now, the company's historical growth rate over this period of time has been 16.32%. So we're using the fair value ratio of Peter Lynch, made famous, the PE equal to growth rate. So we've drawn the orange line here at a PE ratio of 16.32. This is a valuation reference line. But what's striking about looking at Dell Computer here is that I want you to notice, since it went public, the market has applied a very, very low multiple. It was almost like they were saying, show us something. We have to see something, because the stock was trading at 5 and 6 times earnings in 2018. In 2019, it got down to 2 and 3 times earnings, even though their earnings growth was really pretty good. But then they started to recover coming out of COVID, and they got back up into the 6 times earnings and even got as high as almost double-digit earnings. They got up to 9.5 times earnings in 2022. But then starting in 2023, we see this increase. Now, I believe that virtually any stock, even a no-growth stock, ought to trade at something around 14 or 15 times earnings. So I consider these to be extremely low valuations. But remember, FastGraphs, the fundamentals analyzer software tool, is a tool to think with. And what that means is it means that you're able to analyze data and evaluate how the market has behaved as well as how the company's behaved, and then evaluate that and think about what it would mean to you as an investor. Now, obviously, you were able to buy this stock at very low multiples of earnings during this period of time. And that could have been a gift. Now, if you look at since Dell went public, even up until it's continued to trade at around the 6 times earnings, you'd have averaged over 18% a year buying the stock at these very low valuations. But then all of a sudden now, with the advent of artificial technology, we saw the stock rise to this 19 multiple. In May, actually got higher than that. It got up to a 20 multiple, but this would have given you almost a 40% annualized rate of return over this period of time. Now, we've seen a correction where the stock has now come back to about a 13.39 multiple. It has started paying a dividend. The dividend's been growing. Its current yield is 1.78%. Now, so the company looks very, very interesting. But now here's the hat trick and here's the question. Are investors now going to be able to accept the fact that they can pay higher than the 6 times earnings? You see, FastGraphs presents the facts and gives you the information. As I said, it's a tool to think with, but you still have to make the decision, because I don't consider a 13 multiple for a company as high quality as Dell to really be an outlandish multiple. I think it's really a decent multiple for the stock. All right. Any stock under 15 times earnings to me, especially if they're growing, is a reasonable price to pay for stocks. That's an earnings yield of 6.67%. We currently have an earnings yield of 7.47%, which is pretty attractive in my opinion. Now, looking at the future growth potential of Dell, if we go into the forecasting graphs here and look at analysts expect, and it's followed by a reasonable amount of analysts. There's 19 analysts for fiscal 2025, which again ends in January of 2025. And then there's 17 analysts in fiscal 26, and we're looking at just under 9% for this year, followed by 16% next year, and then 17.89% the following year. Now, that would imply about a 15, closer to a 15 PE than a 16. Now, putting our cursor here and just running a what-if calculation, that would mean we could earn 23% a year if the stock traded at a 15 multiple out here. Now, if it continued to trade at these low multiples, there could be some potential losses. So if we go to the normal multiple, which has been below 6, then it does not look so interesting. So now, again, the question is, are we going to assume now that the market's giving it normal multiples or not? That's the question you're going to make. And as far as earnings growth is considered, they have a pretty good scorecard. The 2-year forward with a 20% margin of error has been spot on. They did have earnings miss of 17% in 2022, but otherwise a pretty unblemished record. And on a 10% margin error for the 1-year forecast, they beat it 50% of the time, hit it 33% of the time, and only missed it 17% of the time. So the company's been pretty decent as far as how analysts have been able to forecast the company comfortably. So I think these numbers could be realistic. Now, the real question is the stock expensive today or is it reasonably priced? Now, Dell is really innovative in AI, and they have a pretty strong deal with NVIDIA, which is a very big positive. NVIDIA, of course, being the 800-pound gorilla, if you will, in AI. And so the company's really well positioned from that point of view. And again, it's considered one of the most innovative companies in what is really a very highly competitive market. And they got competition, which I'll talk about here in a moment, from several major players out there, some of them international, some of them U.S. Okay, and so I do want to take a look at Dell compared to its competitors, but their competitors are also stocks that you might want to take a look at. And again, this is pre-research stuff here. Dell has performed really well here in the last year, but it's still trading at a reasonable valuation compared to stocks like NVIDIA and Broadcom and others in the tech sector that are trading at really high multiples of earnings. So let's look at some of the other competitors here. One of the major ones in the U.S. would be Hewlett-Packard, or HP Inc. actually. It's the old Hewlett-Packard. Now, once again, we see a company since coming out of I call it the Great Recession of 08 and 09, it's traded at almost single-digit multiples much of the time here. And so this is like the forgotten tech, if you will. Earnings have been strong and good, a little bit cyclical, but it's averaged almost 9% growth. In my world, like it did historically prior to the 08-09 recession, it wasn't uncommon to see the stock trading at 15 or higher multiples. That's what the PE of the orange line in this example is. But we also see since that 08 recession, we had these very low multiples. Now it's still trading at an under 10 multiple. Okay, so in this case, looking at Hewlett-Packard with a 3% dividend yield, especially if you're looking for income, you could look at Hewlett-Packard, and even if you applied the normal multiple here of 7 or 8 times earnings, there still would be an opportunity here for a nice 3% dividend yield and some decent growth going forward. But again, if you assume the market is coming to its senses and we see a higher multiple, then Hewlett-Packard could be, or HP Inc., I should say, could be a really interesting investment. But again, this is technology with an AI opportunity at a very reasonable price. Now let's look at some of the other competitors here. Let's look at Apple, of course, and Apple is a major player in the PC market. Now looking at their earnings growth has been extraordinary, but in more recent years, we've gone to about 14% growth, but they've been selling at very, very high valuations. Now, interestingly, Warren Buffett allegedly has reduced his position in Apple dramatically. I don't think that's because he doesn't think Apple still has a bright future. I personally do. I think Apple's going to continue to probably grow at double-digit rates. I just think the price you pay, as Warren often said, price is what you pay, value is what you get. I think you're really paying a very high price to invest in Apple today, and I think that's why he got out. But I think if Apple would come back to reasonable valuations, like it traded at all through 2015, 16, 17, 18, et cetera, then Apple would be another stock to add. But Apple is a major player in there also and will be participating in the AI revolution. The next stock that I want to look at is actually an international stock out of Hong Kong. Now, it's very cyclical, as you can see, and not really sure about the currency here. This is basically in US dollars, and there'd be currency conversion issues and so on. But we're looking at a stock here that's forecast to grow at over 23% a year. It's one of the leaders. It's probably the biggest, I think, maybe in the world, Lenovo Group, as far as building computers, especially in the international markets. And the company does have tremendous growth potential. Now, their normal multiple, again, has been 10 or 11, but in this case, even at that, if it's traded at an 11 or under 12 multiple, you could still make 15 to 20% a year. On the other hand, if it traded at a multiple in line with its growth rate, in this case, it'd be 23, you could be making unbelievable rates of return. And again, it all really depends on how market sentiment decides to value it. Now, you can see, looking at it from the long-term perspective, you can see that it was not uncommon to be trading at 15 times earnings or higher for really most of the time, notwithstanding these periods where we had these cyclical downturns, but yet even then the stock held up. So Lenovo Group is a very interesting one to look at. The next one that I want to look at here is Acer Inc. And now this is a company that's obviously had a very, very poor record. It's a Taiwan technology and hardware. Fastgraphs has trouble even giving us a real chart. If I looked at it from the standpoint of the company on the OTC market, this is what I get. Let's take a look at it in its actual market, in its primary market, which would be Taiwan, and see what it looks like. And we see a better picture, but we still see a stock that's really got some real issues as far as earnings go. So this is one that I wouldn't be too excited about if I was looking at it. Now, I also included stocks like IBM because they are in the technology sector, but differently. If you notice, we've got these information technology companies in here that are mostly technology, hardware, and storage producers. But the real reality of it is that the system software company like Microsoft or broadline retail like Amazon, and then, of course, IBM and IT consulting and other services are also in this AI game, and they compete with Dell, like Amazon with their AWS business and so on, but even though Amazon's considered a broadline retail. But again, these are some of the major technology players here that are reasonably looking. Now, if I go on and look at some of the others in this space, competitors to Dell, to just move on here a little bit, we look at Asustek Computers. They've got a kind of an interesting chart. Long times where there's dead money owning a stock like this. But again, thanks to AI, they're beginning to get some mojo going here. Now, this is a global depository receipt, very similar to an American depository receipt, but this is on a global scale. Again, this is a Taiwan company. Looking at it from the future, we see really nice growth here as well. So if you're not afraid to invest in international companies, there are some opportunities in those areas. But information technology has been a really unloved industry. I think this video kind of shows that with some of the valuations we've seen. But now with thanks to AI, we're starting to see some increases in valuation. And some of these stocks may be worth researching because they're still trading at valuations that make some sense compared to some of the big names like NVIDIA and Broadcom and some of the others. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. Just taking a little bit of a different look at information technology, especially the PC manufacturers and the ones that are going to be participating in AI. There are some very interesting looking companies here. I'm not recommending any of these for purchase today, but I am saying that if you're interested in technology and looking for a way to play the artificial intelligence game without as much risk as some of the other names, then I'd say some of these stocks are worth taking a deeper dive into. So do your research, conduct your own personal research, and as I said so many times in this video, with FastGraphs, it's a tool to think with. Analyze what you're seeing, and then try to make decisions that you're comfortable with yourself when you're doing it. And I hope you enjoyed this video. If you did, give me a like. Also, take a look at FastGraphs. We just made some recent improvements on the tool with our new dashboard feature and stuff that you guys are going to be able to look at. The tool keeps getting better and better, and I'm so proud of our team for the hard work they're doing. So take a look at it. If you haven't taken a free trial, take our free trial. Thanks for watching. We'll be talking to you again real soon. By the way, my next video, it'll be next week, I'm going to be covering what I consider to be one of the superstars in artificial intelligence that has given us an opportunity to buy it. Now, it's aggressive. It's going to be more, let's say, higher risk than what we looked at here today for the most part, but it is one that's going to be a good opportunity. I look forward to showing you that in my next video. Thanks for watching.